Introduction to mining and staking. So what is mining and staking? Mining, like Bitcoin mining, is the process of creating a new coin through calculating a very complex mathematical problem using your computer, right? The different forms to mine, there's mining such as proof of work, which is Bitcoin mining. You have staking, which is done typically by proof of stake, where it's not done by mining like with Bitcoin, where you use power. You basically use, similar to percentage ownership in stocks or equity, you basically use a consensus mechanism where people can vote and basically confirm the blockchain using a consensus of their stake in the network. So for example, Helium Network has a hardware miner, which I have over here somewhere. Actually, I'll just Google it, right? So you have Helium Network miner, right? So these are examples of miners. You plug them in, and you basically, with Helium, you connect the miner to your, kind of like this. You connect the miner to your Wi-Fi via Bluetooth, and it shares your Wi-Fi connection. In exchange for that, you're mining Helium tokens by sharing your Wi-Fi. You're basically earning new tokens that have never been seen before. So that's basically mining at a high level. Then staking is similar, except it's done through software. There's no like physical or power. It's all done through software. Like Ethereum is going to shift to proof of stake with ETH 2.0. And staking is a great way to earn extra yield on your tokens, right? So for example, Matic. Ideally, anything you're holding in your portfolio for the long term, you want to earn extra yield on it. So if you have go through your portfolio, whatever you have. If there's staking available, stake it to earn extra yield. If there's mining, if there's yield farming available, yield farm it as well to earn extra yield. So a good platform is Staking Rewards. If you go here, stakingrewards.com, this shows you the different rewards you can earn for staking different crypto assets, right? So this shows you the top 10 crypto assets by staked value. So right now, wow, surprisingly, it's Solana. Okay, I didn't know this was the case. So Solana has $77 billion staked, and the reward rate, or the APY, is 6%, 6.05%. And 76% of all the tokens circulating for Solana are staked. Then we can go through all this. So let's look at what has the highest reward rate right now. Okay, Olympus DAO. Okay, so this is actually a good segue into DeFi 2.0, but let me first finish up staking. So you have Olympus DAO, which has 5,900%, almost 6,000%, which is crazy. You have SwiftChain, which is a DEX on Cosmos. We covered. Scored over 80% on code review. This is actually on my watch list. Didn't know it was this high. Very interesting. Axie Infinity. Right, then if we go to actual staked value, which was what we were looking at before, Solana, Cardano, Ethereum, Terra Luna, Avalanche, which actually reminds me, I have to stake my Avalanche. But if we go to actual highest percentage of tokens staked, not sure. Okay, so these numbers seem kind of wacko. We have Mina at 98%. That's very interesting. But okay, so what is staking, right? Staking is similar to what we did with Armor. So in this case, if we go to, for example, I'm staking Matic network staking. I'll just Google this. Always go through official platforms for staking. So for this, we'll go Polygon website. So let me connect my wallet. Okay, so basically staking is you take, okay, looks like I have to sign something. Okay, I cannot do that then. Okay, I wanted to demo that, but I cannot. Okay, but basically staking, I'll just explain the concept. Similar to what I did with yield farming, I take my tokens, I lock them up for a period of time. In exchange for that, I earn yield. It's that simple. right? Kind of like a savings account at a bank account, right? You basically go to your savings account at your bank, lock up your money, they give you a yield, right? That's all staking is. Now, let's segue to DeFi 2.0 and why it's so disruptive, right? So DeFi 2.0. So we talked about liquidity pools and why they're of value, because basically any project that wants to bootstrap liquidity on a DEX, like Uniswap, Honest Exchange, and others, they have to give incentives to the community to add liquidity to the liquidity pool, right? To add the trading pairs, because you always have a pair, right? You have the token and the token that's being traded against. It can be ETH, right? So in this case, we have liquidity and ETH, or we had DAI and ETH. But let's say that the issue with all that is there's a finite amount of tokens they can use as an incentive for rewards, right? These are called liquidity incentives or liquidity rewards, right? Eventually that APY will dry up because that APY is coming from the treasury of that project, right? Because any project will have tokens. So let's say we have 100 million tokens and we allocate 50% of them just for liquidity rewards, or incentives to give to LP pools, right? To give to liquidity providers. But eventually those tokens will run dry. And guess what happens? As that APY decreases, liquidity gets pulled out of that LP pool and a rug pull happens. Eventually there'll be no liquidity because nobody's getting rewarded for adding liquidity. So why lock up your capital, right? Because it makes no sense. It's not rational to do as an investor. So when that happens, projects have no liquidity and they're back to square one. So with DeFi 2.0, it's disrupting. Now, actually, this section was not in the book because this is totally brand new. Crypto is so innovative. It's always happening so fast. So DeFi 2.0 flips the whole concept upside down. Why outsource liquidity to the community? The protocol, the project, the cryptocurrency should own its own liquidity. But how do you do that? So it borrows from legacy markets with bonds by creating this new concept called DeFi 2.0, protocol owned liquidity. And Olympus DAO, which I do have as a token, and I'm bullish on, I've been staking this for the last month, maybe month and a half or so. And as you see here, the APY is pretty high. And they have over $2.4 billion total value locked with 710 million in the treasury. I'm probably wondering, how do they support all this high APY? It's all based on game theory and incentives, right? The game theory and incentives have been shifted to add to have people come and want to actually add liquidity, right? So we take the same concept as before, right? Basically what happens is you go to the website, you basically, let me actually log in here. Give me 1 second. Let me find a wallet that has some OM in it. All right, so basically you come here. Okay, looks like I have to migrate to V2. That's been enough. Okay, all right, so I guess I can't really demo this without doing what I wanted to do. Okay, so basically, I'll just explain this at a high level then. So basically, you're adding liquidity as you do with Uniswap, right? As we mentioned here, right? You come here, you add liquidity, except as opposed to staking the token, right? That LP token you have, basically, that token, your liquidity token, is now being resold back to the project, right? Why do that? Because the project is basically going to give you the incentive to do that, right? When you come here, they're basically issuing bonds that you can purchase at a discount. Let me just make sure I have this right, because it is somewhat confusing, right? So let me just go through this diagram, right? How Olympus works, right? It's basically bonding. It's introducing bonds, crypto bonds. Once you get that, if you get bonds from legacy markets, we're bringing bonds to crypto. And the same way the government issues bonds to help finance activity, or how corporate bonds work, how a company can issue bonds at a discount to help finance activity, we're not doing the same thing with crypto and DeFi being done by the project. The project is issuing bonds for LPs, and it owns that liquidity, right? So basically, bond sales and LP fees increase treasury revenue by adding liquidity, right? And then they mint a token, right? Token yields automatically through treasury, blah, blah, blah. Yeah, I mean, I'll just keep it light. Basically, the project issues a bond, right? And you have the incentive of that bond is backed by actual treasury reserves, right? So this treasury balance backs the bond, if I'm explaining this correctly. Somebody please correct me if I'm wrong here. So for example here, this is the market price for Frax, right? Frax is a partner with Olympus DAO, right? So this is the market price, but you can get this at this bond price at this discount, right? And they give you an ROI for that if you lock it up for 5 days in this example, right? But that's really DeFi 2.0. DeFi 2.0 is essentially crypto bonds. The reason why this is powerful for any crypto investor as we head into 2022 is for the first time we have a new asset class in crypto that has a high yield with low risk, to a point where this made me completely disrupt my entire portfolio and say, why am I holding these altcoins in a bull market that are underperforming when I can have crypto bond that has a lot lower risk and high yield, right? Because we're so early right now that there's a glitch in the matrix, that in typical legacy markets, bonds are very low return investment. They're better than savings accounts, but because crypto is so brand new, so disruptive, and for a limited period of time, we have high yield bonds, and high yield in crypto is 6,000%, sometimes even more, right? So if we go to platforms like Time Wonderland, which has even higher APYs, right? Time Wonderland is a fork of Olympus DAO put on the Avalanche blockchain. Avalanche is a blockchain similar to Ethereum, but different. It's basically an internet of blockchains, kind of. It supports Ethereum blockchain and other blockchains. So in this case, I have to switch my MetaMask to Avalanche. So MetaMask does support several blockchains like Avalanche, Polygon, Binance Smart Chain. So in this case, I have switched to Avalanche. Okay, right. So in this case, we have the same exact concept, right? It's a fork. They took the same code because Avalanche supports EVM, Ethereum Virtual Machine. So all the Ethereum applications can be ported over and run on Avalanche, which is pretty cool, which is why I'm very bullish on it. And not financial advice. Okay, this is the dashboard. Their APY is 70,000%. That is insane. Like basically, $1,000 turns to 70,000. I don't know, sorry, to 700 grand in 1 year. I mean, that also depends on the price. If the price stays stable, right? But still, I mean, right now, biggest wealth transfer in human history is happening right before our eyes, right? So what I'm doing is I'm staking on both Olympus DAO and Time Wonderland, and I just sell my yield every month. Right? I sold some yield recently, about 1 or 2 weeks back, prior to the holidays. But they have $2.7 billion market cap. They have 1.8 billion in TVL, in total value locked into their protocol. And this is the treasury they have that's backing the assets. It's never going to be one-to-one, but this shows you the runway, meaning that how many days would it take for this to collapse, basically, right? So the runway is 407 days before this would collapse, right? So if you're concerned about this being a Ponzi scheme or whatever, I mean, there is treasury backing this. If you understand how bonds work in legacy markets for corporate bonds and government bonds and municipal bonds, we're doing the same thing in crypto, except the bonds are being done with liquidity and the protocol owns the liquidity. And this is very disruptive because now you have trading volume for these projects that is owned by the protocol and is not going to get rug pulled, right? So if we go to, for example, Ohm, right? Ohm is basically a reserve currency, and the trading volume has been pretty high, 63 million daily trading volume. Let me look at this real quick. Okay, this is looking just to switch this up for some reason. Okay, so it's saying to look at staked Ohm. Okay, that is not what I wanted. But anyway, I mean, that's DeFi 2.0 in essence, right? And that concludes mining and staking.